Jonathan, something you've written about is the short-termism in this market right now. Just how much has the regime changed or evolved over the last, say, 6 months? How significant is it?
I think the investment community has lost its soul. I think investors are finding it very hard to do their job, to invest, and I call it T+0 investing.
Walk me through that.
So if you're an investor today and have an investment process, you look at the future and the past. How can you possibly put weight on the future given all the high levels of uncertainty, which are multiple? The yield curve saying recession, political risk, etc. You then look at the past, and no one is willing to put any weight, any investment capital behind prior relationships that are telling you to do certain things like buy value or buy equities against bonds. So no one trusts the future, no one trusts the past, everyone is squeezed into this T+0, and therefore the entire investment community is left blowing in the wind, and that's why markets are so sensitive to every single data point.
So Peter, you've faced the same issue with clients, with investors. What do you tell them right now with that in mind?
Well, again, and I think it fits with this idea that this is going to be still a very extended economic cycle, albeit with modest growth. We think that for medium-term investors, being in riskier assets still makes sense, so we're overweight of equities. We are balancing that, or counterbalancing it with an overweight in cash. But we feel that investors should be seeking out risk premium where there is decent risk premium, and that is still in the riskier assets. We do expect lower returns. I think it's important to emphasise that when you look at equities, for example, profit growth is likely to be quite moderate. We're looking at around 6% this year in the States, perhaps 2% in Europe. Valuations are probably not rising anymore. And so that implies lower returns, but still positive returns.